Yeah, hi, this is Gurpreet Saluja. Welcome you all to the Gurpreet Saluja's Financial Nuggets Live. Today, we are about to start our live session. Uh, Let me see if we are properly connected. So, we are live on YouTube. We are about to start this session in a minute. So, let's wait to let everyone join. So, what? Yeah, so let's start it. So in this live session, what we are about to discuss is about I am about to discuss the journey of the Sensex. Most of the people who are investing into direct equity or equity markets through mutual funds or through stocks must be aware about this barometer. This is Sensex. We will be discussing the journey of Sensex in this episode, in this live session, right? So most of the people are not aware, are investing into equity and equity products, but they are not aware how this journey went through over the period of time. We are now at the one of the almost at the peak of the current market barometer index. So let's start so that I will let the flow of the presentation or discussion that we are about to discuss in this live session continue. So what's our agenda for the day is I will discuss the Sensex returns. The Sensex, the barometer, it is a barometer of 30 largest companies of India as per the market capitalization. So these companies have performed over these 40 years of period very well, right? So Sensex was started in 1979. Though it is a barometer index of the Bombay Stock Exchange, which was established in 19th century. So the index, the Sensex, which is also known as the sensitive index. This is the actually a short form of a sensitive index. That index, which started in 1979, was started with a value of 100. Yes. So if we had invested 1 lakh rupees in 1979, which is exact 41 years ago, then today, as of today, like as on 21st January 2020, the census closed at 41,323 rupees, which means your worth of 1 lakh rupees in these 41 years would have been would have been 4 crore 13 lakh and 23,000. Yes, that's 413 times. Remember this thing that I want you to know this. These values are X dividends. Like there is no dividends involved in these. If you include the dividends that have been declared by these 30 companies over the period of time, it the value of this same investment would touch more than 5.5 cr, right? So in past these 41 years, sorry that it is wrongly mentioned here 39 years, exactly it is 41 years, it has delivered you 15.90 returns. But what I want you to tell through this live discussion is that in these 41 years the census returns were not constant. Let me get you to the browser through the chart. It's a daily chart of Sensex today's. So 1 year chart is like something like this. I want you to grab to the maximum. The Sensex was at in 1986. It was 561. The data is not given for before that, like of 1979. In 1986, as per the Google, you can also search over the internet about the Sensex history. You will find that around 1986, the Sensex was at 561, and this journey was not linear. This journey went through many ups and downs, the 500 to 400 something around, then again it went to 600 and 700 something in 1989, and in 1990 it was around it double, almost double here. Like if you see the journey from 15 June 1990, which was at around 785, it almost doubled in almost 6 months, right? In almost 6 months it almost doubled. It was around for 1200 in 1990 December. Here are the figure that if you'll check that in 23rd November it was 1300 in 1990 same year. In June it was 700, around 700 something, so it almost double in a within few months. So how this is how the census journey went over through, right? In 91 it was 92 it was 4000, which means if in 86 if you had invested 1 lakh rupees in within for 5 to 7 years your investments almost multiplied by 10 times. So this is how equities working over the period. I'm only talking about Sensex, which is an index. I'm not talking about any particular stocks over the period, right? So if you'll see the journey, this journey was not a linear. It went again down and up and down, and this is how the Sensex and equity markets actually work. And around 2004, the major bull run, the biggest bull run of Indian equity market started, and the Sensex, which was around 3,800 in 2003, ended up at 721,000 in 2007 and 2008. 2008, many of people you have been, if you are into the market, you must have been aware of that there was a major bear crash, a global crisis, which I have also discussed here. Let me give you an example. Yeah, so in these 41 years, there were two wars that this country faced, right? Then there were major financial scandals which we faced, like in 1991 Harshad Mehta scam, 2008 Ketan Parekh scam, assassination of two prime ministers of this country. There were three recessionary periods over these in this journey. There were 10 different governments, and an unfair of natural disasters like in Uttarakhand, which happened in 2011, something around right there, and a global crisis as I discussed in 2000, which was a dot-com bubble, and in 2008, which was a subprime crisis that happened in America. So after these major incidences also, the Sensex have delivered returns of more than 15% year on year compounded basis. So this is how equity works. Many people who are investing into equity are investing by recent performances of the equity, right? Or they withdraw their investments when they see a recent fall in the investment. So they are actually the victim of recency bias. It is a psychological term which I will also share discuss with you in our upcoming sessions. So what we want to understand is this: most of people like us, most of investors are investing into equity market within being a victim of a recency bias. What is a recency bias that we need to understand? Recency bias is taking all the decisions based on the recent events that have been occurred in our life. So, if you are seeing that the Sensex is not performing well, and you are seeing the continuous downturn in the Sensex or equity markets, and if you are earlier invested into the market and you are seeing your values falling negative, or you are regularly seeing the indexes falling, then you will there is the most probability that you will not invest further in that same equity product or same investments that you have already done. You will not do the averaging, or you will not top up your investments over the period, because you have seen the recent negative impact of the markets. And on the other hand, that we need to understand very deeply, I hope you are giving most attention to this point. Like, if you will see that there is a continuous bull run in your investments, and you are like, okay, you had purchases your investments last year, right? And you are now seeing that your investments are generating you 20 or 22% returns. It doesn't mean that it will continue to do so. And if you are going to invest just based on the recency bias, there is a high probability you may end up losing your money over the period of, because with the impact of recency bias, you are tying your investments for a short term, like say 1 year or two. You are thinking that the market is in a bull run, I will put my money, I will make quick bucks, and I will get out of it. You will not be able to get out of it, because it requires a lot. You can't time the market. If you are putting your time into the market, you are also generating returns more than 15% over the period of time. I'm not saying that you will continue to make these types of returns over the next 40 years. That is not, may not be possible, because there are many various reasons for the how the economy works and how these census gives you the returns, like inflation, GDP growth. There are many things that we need to consider. But what I am saying, there is a history, there is a track record that we need to understand. Even after this so wonderful track record, Indian investors are not investing into equities. They think that equity is the place where we lose money. Tell me how we have lost the money. Actually, your own country's index, your own country's stock market had created more 413 times of returns of your investments. That's what you need to understand. People say that if you invest in the stock market, you will lose money. How? Tell me how. There is no track record of losing money. You lose money only with if you are a victim of different biases, different psychological your mindsets. If you are You taking investment decision based on the recency bias is also you are being a victim of the recency bias, and you will also end up losing money. If you will be victim of any of the psychological impact of your mindset, then you will lose money. Most of the people come here for investing and getting the quick bucks over the period, right? So if you have invested 1 lakh, you will definitely accept the aspect that you are into the stock market, you are taking the different risks, you should get money, make your money double in 2 or 3 months or in a year or so, like that, right? Which is not possible. It may be possible, I'm not saying it is completely impossible, it may be possible, but if you are every time you are timing the market, then it is not possible. It has proven it has doubled your money, but it has doubled the money or quadruple or even 100 times of your money only to the to the investors who are patient, who are consistently, who have been the faithful followers of equity market. Only those persons have created the returns, like a multi-bagger returns over the period of time. The people who come here for a day or two or a year or two just for the sake of the quick buck that they wanted to earn from their investments, they will always lose, they will always end up losing their money or always end up disappointed with the results from the equity markets. That's what we need to understand. The purpose for sharing these census return was that you need to know that how these markets actually work. If you are in starting your investments into equity markets and you are not aware of these facts, then you need to get your facts cleared, because you will if you are managing your money yourself or you are actively participating in your investments, especially in equity market, then you need to learn about these things. Because if you are not understanding these things, that how this equity market works, then you are making a big mistake. Because if you are actively managing without understanding the activity, the nature of the equity market, then you will not end up with the good results, right, or satisfactory results that you are expecting from this market. If you are expecting rich quick schemes like this into from the equity markets, then you are gonna be disappointed. If you are investing just because of the recency biases, then you're gonna be disappointed. There are many other things that we need to understand before investing into equity, right? So that was the main point that I wanted to share through this live session. There are many things that we'll be discussing over the period of next few live sessions. So again, I want to correct that here it is 41 years, not 39 years. And the return is correct. That is, if you'll calculate the XIR, the annual compounded rate of return, that is more than 15%, exactly 15.90. And these were the major things that was happened into the journey of the Sensex. Sensex is again a barometer of equity market. So here is what I want to share with you. The journey of the Sensex in July 2010 and March 11 and so on. The market is on a continued bull run. So it will there are many things that we need to understand, that equities have created the wealth for many peoples, and it will continue to do so, but only for its faithful investor. If you are not the faithful investor of the equity market, then you will never be able to create the good returns. At the end, that what I would like to say is that the market, the growth is permanent and the fall is temporary. There were the falls in last year. Many people thought that the same index that was around 38,000 in 2018 will fall to more than below 20,000 levels. There were many people, many predictors who were predicting that the markets will fall like crazy. I will again like to tell you that markets can never make a permanent or lifetime low, but it will continue to make lifetime highs over the period. That's the fact of this market. So you have to be a faithful follower of the equity markets. If you're investing into equity and you want to garner the good results over the period of time, and you want to actually create the wealth at a decent rates, then you have to be a faithful follower, and you have to continue to investing in the markets at every point of level. It is not for the soft hearted people, right? It requires a lot of courage that we need to understand. Most of the people are investing into equity just for the sake of the high returns, but they don't have the courage to invest into equities. That for the people who are soft hearted, it is not for them. That's what we also need to make it clear over the period of time, right? So while making our investment decisions. So that's for all for the day. Let me check if I have any live queries, uh, so that we can. Let me check if I have any live queries on my YouTube. So if you have any of the queries, you can also post on a live stream further. Otherwise, you can post your queries on the comment section, and I will definitely get back to you over that. Right. So that's all for today. It was a nice interaction with you all. It was a second live session. I'm trying to improve my sessions day by day. It's a new experience for me also. I hope I apologize if there is some mistake with me from my side. So I will try to improve more and more over the period of time. Right. That's all. Thanks a lot. Thanks a lot for joining in. Goodbye.